Hello and good evening, everyone. Today's webinar topic is how to create a complete portfolio using mutual funds. So, for this, we have with us Miss Lisa Barbora, ma'am, a financial coach and personal finance expert with over 2 decades of experience in financial services. Ma'am's expertise spans wealth and asset management, financial writing, and investor education. Lisa Ma'am is a certified financial coach, practitioner, trained by Wise Monkey Financial Coaching UK, and the author of Money and Her. Ma'am has conducted financial awareness sessions of various organizations including FICCI, FLO, Paytm Money, Thomas Cook, and contributes regularly to publications like Money Control and Live Mint. Now, a short glimpse about NISM. NISM is a public trust established in 2006 by SEBI, the regulator of the securities markets in India. The institute carries out a wide range of capacity building activities at the various levels, aims at enhancing the quality standards in securities markets. Now, before beginning this session, I would like to request all the participants to note some important points. First, question will be taken at the end during the Q&A segment. Second, all participants will receive a participation certificate within 3 to 4 working days. Third, the recording of this session will be available on NISM YouTube channel. Now I request ma'am to begin with this session.
Hi, Sahil. Hi, everybody. Thank you very much for that introduction, Sahil. And I will just share my screen so that everyone can see. Yeah. So today, as Sahil mentioned, we are talking about how to create a complete portfolio using mutual funds. Now, by now, there is enough information to tell everybody that investing is, of course, a very important aspect of our money lives, which allows us to create wealth, really. And recently, when I was at another session, there is a confusion around, what investing really is. So when we say investing, we are really talking about your goals, your plans, your aspirations, and long-term wealth creation, and not about trading where you're trying to kind of capitalize on the daily movement in prices of different assets. So I just want to make that distinction in the beginning because sometimes, people are confused. Yes, that is also a way to kind of use your money to grow your money. But that's a whole different discussion, which is trading. Investing is a very different discussion. So with that, let's start. And I would really like to begin at why we invest because investing is not just about where to invest and how much return we make and the risk return dynamics, etc. Investing is also about understanding what do we want our money to do for us? What is it that will benefit us if we invest this money? So, what is the purpose of the investment? And as you can see, the purpose of investment can be anything, right? From planning a vacation, which is 1 or 2 years away, to maybe planning the start of your venture, which could be 5, 10 years away, to your children's future, if you have a family, to just creating wealth, to building an emergency fund, to wanting to multiply your money. So, just wanting to multiply your money is also a goal for which you need to invest. It's nothing wrong. You don't have to have concrete goals. Yes, concrete goals are easier to imagine, like buying a house or buying a car or something like that. But even other goals, which are, which don't have to be so well defined. So when people are younger in their, mid 20s to early 30s, there could be no such concrete goals. It could just be that I want to save my money and I want to grow my money, and that's good enough. And it could also be that you have some short term goals like wanting to buy an expensive gadget in 1 year's time or wanting to go for a 1 month tour of Europe after 1 or 2 years. All of those are also goals, and you can invest in order to fulfill those goals as well. So it's very, very important to know why you are investing, whatever the reason may be. So we begin with that, not with which product. and how much return can I make. The next thing is to actually assign timelines, because all goals are not the same. All goals don't have the same time focus that we need, right? Is it now that you need the money, in the next 6, 8, 10 months, 12 months, or is it later in 5 years, 8 years, 10 years? That definition of your goal, of why you're investing, will actually help you decide which asset can work for you. Money you need now, which is in a year or two, needs capital safety and flexibility. So you cannot hope to invest the money you need in the next 1 year in a very volatile asset where the price goes up and down. Because if that happens, you don't know how much you may have left when you actually need the money, because the timeline is so short. And you need flexibility. You may have a capital safe investment, but it might have a lock in of 5 years. That won't help you either. So keep in mind, money you need now needs capital safety and flexibility. Money you need after 5, 10, 15 years needs to grow. What does it mean to grow your money? There is one aspect of our financial lives which all of us are subject to and none of us can escape, which stops our money from growing. And that is inflation. Inflation is the price rise in any economy, and that eats into the value of money. So, the value of your money today will be lower a year later, 2 years later, 3 years later, and 10 years later. At an inflation of 6% a year, the value of your money will be just slightly more than half of what you have today. If the value of your money goes on declining, then how will you make more money? For that, you have to invest such that you beat the inflation level in the economy. So, over 5, 10 years, if you want to actually grow the value of your money, you need to invest to beat inflation. Now, it's good to know this, that you need to assign timelines, and accordingly, you'll have the right reason to invest, the right asset to invest. But usually, it's not like you only invest in one or the other. You have to try and combine both, because if you only invest for wealth creation, which sounds good, that why would I not always invest to grow my money? Whatever the purpose of my investment may be, why can't I just invest always to beat inflation and grow my money? Well, because some of your requirements, which are going to rely on capital safety, you will not be able to take the risk required, which is there for wealth creation. Hence, your money needs, if you only invest for wealth creation, your money for your needs in the next 1 or 2 years will be at risk. So, you will not be able to have that capital safe portion of your portfolio. If you only invest for now, some people are risk averse and they say that I do not want to take that risk of long term investing, and it's okay, I'll just put my money in capital safe products. Then your money in the next 10 to 30 years will not grow and will not beat inflation. And as I told you, if it does not grow, the money that's just kept in your bank will be worth slightly more than half in 10 years' time. So it's imperative that in the long run, you need to allocate some amount of your portfolio to investments that actually grow the value of your money. And you need to allocate some amount to investments which have a aspect of capital safety in them. Of course, flexibility can be there in both. Now, this is the typical kind of risk return graph that you will see for all kinds of investments. And we haven't come to mutual funds yet, but I would just want to clear out all these things beforehand, so that when we do talk about mutual funds, then we understand what is placed where. So, what is this? Some of you may have seen this kind of simple graph before, but this is although a simple graph, a very, very important graph, because this tells the story of how you need to think about structuring your portfolio. The part of your portfolio which requires capital safety, which you cannot under any circumstance take risk with, falls in the lower part of the graph. And risk and return go hand in hand, which means that if you are going to take more risk, then the probability of earning higher return is there. Or if you flip it, if you want to earn higher return, you need to take more risk. However, with some investments, the objective is not higher return. So there we stick to the low risk part of the graph, and we stick to assets which help us build some kind of return into it, but we don't take risk with the capital. And if you're not going to take risk, then how will you make the return, right? So you have to contend with that part of your portfolio. Now, as you go higher up on this graph, you will find that the risk portion actually goes up and so does the return. So equity typically is on the higher end of the graph, but let's understand what the risk in equity is as we talk about it. The risk is not so much that if you invest in equity, you will lose your money, or that it is a gamble, as most people say, that it's only a gamble. Maybe I will make money, maybe I will not. No, if you invest in well researched equity, what you are doing is you are buying a little portion of a company, actually, of many companies in a portfolio if you're investing through a mutual fund. Now, when you buy a small portion of a company, it entitles you to a small portion of the earnings of the company that are given out as dividends, and it makes you a shareholder. The price of the stock of that company is determined according to the expectations of the earning growth. Now, companies, as we know, are not gambles, right? Companies are organizations which actually produce some goods, some services, which people like you and me are willing to pay a price for. And on the basis of that is what their earnings grow. When their earnings grow, their stock price also follows that growth over longer periods of time. There are companies which are more than 100 years old and have been listed on stock exchanges for decades. They don't simply go out of vogue, right? But what happens to their price on a daily basis? It moves up, it moves down, it moves up, it moves down. That happens because of the daily news events. It happens because of demand and supply on a daily basis. But over a longer period of time, the stock price of a company practically mirrors its earning growth. So, this is not a gamble. You are investing in a business which you expect will keep growing. The gamble is that you expect the stock price to hit a certain level in the next month, in the next year, in the next 2 years. That doesn't always happen in that way. It takes time. And hence, while equity has high volatility, which is the risk that it has, good quality equity, the volatility smoothens out over a period of time. Hence, any graph, any chart you see of equity price, over a long period of time, it moves in one direction. When you see short bursts, they will be up and down. Alternate investments are also, they can combine some equity like unlisted shares, unlisted companies. Now, the risk there is not just volatility, but also information which we do not have, which even people who are investing may not have, because those companies are not required to make that information public. So you are just going to rely on, somebody's tip. If you're investing in startups or ventures or private equity, those are based a lot on somebody's tip, what one or two people think about the company, because we don't have that information in public. There are not many people analyzing the finances of those companies because they're not available to them. So that's why the risk there is higher. Also, alternate investments include things like, some real estate, some commodities, some currencies now, and of course, cryptocurrencies as well. And again, there, in case of things like currencies, cryptocurrencies, the whole basis of price is expectation. There is no value or there is no goods or services on the back of it. And that's why those are slightly more risky. and they're on the upper end of the spectrum. Now that we can understand, of course, cash is at the lower end because there is no, I mean, there's no apparent risk. There is an inflation risk which reduces value, but there's no apparent risk of capital moving up and down. Now, low risk goals, as we spoke, which are just a few months or 1 or 2 years away, require your allocation to be in low risk, stable return products like liquid funds, debt funds, gold funds. And we will talk about this slightly later. And high risk requires the exposure to equity, like hybrid equity funds and international funds, also can be included in this. And now we can, I think, start talking about particular types of funds that are available to you and how you can include them in your portfolio. But at this stage, what I would like to say is that once you begin by sort of identifying why you're investing, and you may have one reason to invest or you may have four, and you bucket them according to the time horizon, according to the priority of the investment, then you will be able to decide whether you need a low risk stable return product, or you can use a high risk product where you have more time to invest. Now, benefits of investing in mutual funds. Of course, your investment needs can be addressed by all kinds of different products. They can be small saving schemes, deposits, they can be alternate investment funds, they can be commodities, cryptos, anything, or direct equity, even. What are the benefits, though, that mutual funds give us packaged into one kind of product? There is transparency. You know where you are investing, how much you are investing, at what point you are investing, what is your gain. All details are there in your account statement, which is emailed to you. Plus, there are fact sheets and daily disclosures on the website of the mutual fund where you will be investing. So you can see exactly what is happening in the scheme. At least once a month, you will be aware of the portfolio of the scheme and you will get to see what are the securities in the scheme. Any announcements on changes of, say, expense ratio, which is the cost of investing in a mutual fund, or any kind of other kind of important changes will be communicated to you by the mutual fund via your email. Also, lot of there are a lot of public sources, a lot of websites which collate, because this data is available to the public, they collate the data and present it to you in a very analytical format where you can actually see what peer sets, what different schemes are doing, and you can sort of check through what portfolios of different schemes look like within the same category, etc. There is also a lot of flexibility. Mutual fund schemes mostly are open ended, which means you can invest at any time and you can withdraw at any time. Depending on your goal, however, you should have the discipline to withdraw from a certain type of mutual fund. Remember, we said for your short term goals, you need liquid funds or debt funds. Those you can keep withdrawing from anytime you need. In a fixed deposit, you may be able to withdraw, but it takes time, and you will be, you can't withdraw little bit. If you have a 1 lakh rupee fixed deposit, you can't withdraw 50,000 from it. But in mutual fund schemes like liquid funds, you will be able to withdraw whatever you need. So that flexibility is there. If you're in dire straits, your emergency fund has run out, and you really need to access your long term investments in equities, even those you can access, and you have the flexibility of taking as much as you need. You don't have to take out the entire thing. You can leave the rest invested. Choice of asset, of course, right from money market securities to now even InvITs and REITs are available across different mutual fund schemes. InvITs and REITs are available only in the multi-asset format of mutual fund schemes, but you can get exposure to whatever asset you want. Automated investments through SIPs, you can, just start an investment automated and forget about it every month. That will happen on its own. So you don't need to take action on your investment every month. You can review it once in 6 months, once a year, review, reset your SIPs, and you can play it that way. But it's the automation helps you just do the action once and then leave it. So you don't have to keep going back to what do I do now. And of course, SWP is also a very important automation in mutual funds, which is the other end of the spectrum. If you need to take out a second income from your mutual fund schemes, then you can use the SWP format. Diversification is one of the main advantages, where you are not able to do that through, say, direct stocks, etc., where your bandwidth to select stocks is limited. Mutual fund schemes have qualified professionals sitting there making those portfolios with 30, 40, 50 stocks. So the diversification is inbuilt. Liquidity. So whenever you want to exit, it is there. You can go sell your stocks, sorry, your mutual funds. Unlike, say, chunky investments like real estate or even your alternate investments, you may or may not be able to sell immediately when you want to sell. And even if you are, you may not be able to get the price you want. You may have to get a distress price. That does not happen when it comes to mutual fund schemes. They are regulated. Now, this is a very big thing because it means that if you undergo some kind of grievance, there is a procedure around how to go about resolving that. That procedure begins with the mutual fund house and you calling in to tell them about your grievance, and moves on to the regulator, to the scores platform that SEBI has instituted. And you can even go down your grievance redressal through that route. So that is also very important. Of course, professional management. So people who are qualified, who are experienced in this, are forming those portfolios. It's not just somebody giving you a tip or you going by your gut. So there is a structure, there is flexibility, there is transparency when it comes to investing in mutual funds. And that is the main benefit, because it means that busy professionals or even students who are busy with their other work, or their studies, etc., can focus on that. You can focus on where you are deriving your skill from or where you are deriving your active income from, and leave your passive income generation to structured, managed, regulated products like mutual funds. Okay, so let's go back to how we can use mutual funds to create our portfolios. And we begin with the very basic low risk goals, because those are the ones that are most visible to us. You may have heard about emergency funds and the need to have an emergency fund. Now, that is a very low risk goal. And everybody, no matter what stage of your earning life you're in, should have an emergency fund, which is like a plan B, like a backup if things go wrong. There can be financial setbacks of various kinds. In fact, any setback in life, it may not be financial to begin with. You could have an accident, or something could happen to your family member. Usually, the consequence has some financial impact, and you should be prepared to address that without going into your long term savings that you have planned, say, for your retirement or to fund your venture, etc. So that is a emergency fund, and it can be created with very low risk mutual fund schemes. Or, as we spoke, a goal to, say, plan your vacation, which is a year later. A lot of people are planning destination weddings and are paying for them, and usually it has a 1 year to 18-month kind of period of planning. Now, that much time is not enough to give an equity investment, because we know anything can happen in the markets in short periods. So ideally, you should be looking at some kind of short-term debt funds, ultra short-term funds, for those kind of 18-month to 2 year goals. It could also be collecting enough for a down payment on a house or a car, or even buying a car. All these kind of goals which are there within like 1 to 3 years, or can be addressed through debt funds. Now, debt funds typically are just a portfolio of money market securities, government bonds, private corporate bonds, all put together depending on what kind of risk is there in the fund and what is the time horizon of investment. Liquid funds are the most basic, lowest risk, where you are just parking your money. And usually in liquid funds, it invests in money market securities with up to 60-day maturity. What that means, what that does for you, how does it make it low risk? It makes it low risk because the uh, the average maturity or the maturity of that portfolio, remember they're investing in bonds which are fixed income securities, and they come with a fixed maturity. When the maturity is close by, a month or 2 months away, the kind of ability to generate the income that the security promises is higher. When the maturity is, say, 10 years away, then the visibility is lower. Also, there is something called interest rate risk. Interest rate risk is the relationship between the change in interest rates and bond prices, and they are inversely related, which means that if interest rates fall, bond prices rise, and if interest rates rise, bond prices fall. And higher the average maturity or the maturity of the portfolio of securities in a bond fund, higher is the risk, which means that the daily price of your bond fund will be more volatile. In liquid funds, because the maturity is so low, the risk is low and the volatility is practically negligible. And that is why it is a very low risk, stable return option for your near term requirements and for things like emergency fund. Also, in liquid funds, if you need the money, you can get it in 24 hours. There are some liquid funds which enable an immediate kind of redemption up to 2 lakh rupees as well. So those are the advantages. It is really a substitute for you to park your money, which you don't want to leave idle in your bank account. So it has high liquidity, stable returns, and redemption, which you can get within 24 hours. For your goals, which are, say, between 6 months to 2 years, you can shift to ultra short term funds, which are also quite low risk, but redemption may take slightly longer than 24 hours. It can take up to 3 days. The average maturity of the portfolio or the maturity tenure of the bonds in the portfolio will be slightly longer, and the yield of the portfolio or the return of the portfolio will be in line with that, so slightly higher than, say, liquid funds. But at the same time, this is also very, very low risk. And of course, if you have slightly more time, up to 3 years, then you can go with short term debt funds as well. Again, the only change here is that the average maturity of the portfolio, the maturity of the bonds in the portfolio are slightly higher, 2 to 3 years. So you can plan it out accordingly. Now, for your medium term goals, so for the money you need in, say, 3 to 5 years, here you can use certain funds which actually also combine other assets, because fixed income funds can only deliver returns up to a certain level. Remember, we said the risk return is such that higher the risk, higher the return. So fixed income instruments do not take high risk in that sense. So your return is also limited. But when you have 3 to 5 years for your returns, for your goals to be fulfilled, then you can actually stretch your sort of risk appetite a little bit, because as we spoke, certain assets like equity do tend to smoothen out over longer periods. So we don't want to invest in equity for 1 or 2 years, but we can stretch that when we are going up to 5 years. Hybrid funds include equity and debt investments or fixed income investments in different proportions. Depending on whether you want to take little risk or more risk, you can choose the type of hybrid funds, because you get aggressive hybrid funds with 65% or more in equity, and conservative ones also with only 20% in equity. Of course, returns will be commensurate depending on what kind of equity exposure there is. The good thing about hybrid funds is that they do have a cushion from the fixed income or the debt investments. So if the equity markets crash, your hybrid fund returns will not fall by as much as a pure equity fund, because there is a debt cushion. The returns will be premium, because if you are investing for 5 years, you do need slightly more premium returns that are going to beat inflation. So you will get that from the equity portion. And there is high liquidity in these schemes, because again, you can invest at any time you want and you can withdraw at any time you want. And you can withdraw at the price that you want. You don't have to struggle with if you're sort of withdrawing at a day's notice or something, you don't have to struggle with how much you will get back. You will get back as much as you have invested or whatever you want to redeem. So you have to choose the allocation to hybrid funds as per your needs. Your entire portfolio does not need hybrid funds, but a portion of it can benefit. And be careful that on the fixed income side of the hybrid funds, you need to pick funds with um, low credit and low interest rate risk. What does that mean? The credit risk actually shows in fixed income funds how the quality of the portfolio is. A high quality portfolio has low credit risk, and interest rate risk, as I explained, depends on the average maturity or the maturity tenure of the bonds. Keep it on the lower end, like short term bond funds we saw had, 2 to 4 years of average maturity. That's good enough for your hybrid fund. Also, do not go for like very long 5 to 10 year kind of average maturity in the fixed income portion. And all of this, remember, we said mutual funds are transparent. All of this information is available in fund fact sheets every month. Multi asset funds, along with equity and debt, combine other assets like gold, REITs, in which you have to read. Every multi asset fund will be different. You have to read the scheme information document to understand what all is included in that. But these are also a very good way to have your medium term kind of goals addressed. And again, keep on the fixed income side, because you're taking risk with equity, right? You are taking that kind of short term risk coming in with equity. You don't want to take risk with your fixed income portion. So make sure that the credit risk and interest rate risk is low. Look for high quality credit portfolios, and look for relatively lower average maturity portfolios. Gold funds. Now, gold is a way to hedge against inflation risk, and gold ETFs, gold ETFs, and gold funds are available under the mutual fund umbrella. They are a very good way to get exposure into gold. Again, your 3 to 5 year medium term investment can go here. It gives you the benefit of gold price gains if that is the expectation, without the problem of holding physical gold. So, gold funds will give you that benefit, but you don't have to take the pains of going to a jeweler, holding a lot of physical gold, opening a bank locker, and putting it in there. You can just buy units of gold funds which track gold prices, and it comes at a low cost as well. There is no GST and all of that storage cost, etc. Mutual funds for your long term goals. Now, clearly, this is equity, which kind of addresses your 8 to 10 year plus goals. In an 8 year period, we found that across time periods on a rolling return basis, equities is able to deliver positive return. And in a 10 plus year period, 75% of the time, equities are beating inflation. So, um, this is really the way that you want to create your slow and steady long term wealth creation, where you're not really piling on risk in order to create wealth, but you are going with what is professionally managed, structured, good quality investments. Large cap equity funds are the go to for beginners when you are just about starting out. Large cap equity funds are a product which can address those needs of people who are just starting out and do not have any experience of market linked investing. So they are going to be portfolios that have the biggest kind of market leader companies in the economy. So these companies have been around for a while, and also these companies are majorly going to form part of the index, which is the Nifty 50 or the BSE Sensex. So you know that you are investing in large companies, good quality companies where there is great earnings visibility, and there are many people, kind of analysts, professional fund managers who are buying into these stocks. So there is good liquidity in these stocks as well. So that's why this is a good way to begin your equity investments for sure. And they're best suited for, at least a 5 to 8 year kind of exposure. Here you also have access to a lot of passive funds. Passive funds are funds where there is no fund manager deciding which stocks to include or not. They just mirror a given index. And usually the Nifty 50 index or the BSE 30 index, those are the popular passive funds. In fact, passive funds with those indices, underlying indices, are some of the largest mutual fund schemes today, because that's the simplest way to invest. Now, why are they there? Because without the fund manager managing anything and you're just kind of mirroring what is in the index, the cost is very low. Also, what happens is that in the large cap universe, it's very defined to the top 50, 100 stocks. So there's going to be a great overlap even if the fund manager is selecting those stocks. So this is an easy way to do away with which fund manager is good or which fund manager is bad, or trying to decide that and saying that, okay, you know what, this is available for me. It just picks the top 50 stocks in the economy, or the top 30 stocks, depending on which index you go with. So let me just buy into this. Then there are mid and small cap funds. These are actually quite good for a slightly longer period of kind of investment, 10, 15 years, because here the volatility is slightly high because of the nature of the stocks themselves, which come from, which are slightly different to large cap stocks. Small cap and mid cap stocks do not have the rigor of research and followers as the large cap stocks do, or the rigor of daily kind of demand and transactional activity that large cap stocks have. And hence there could be more mistakes made in this, or more stocks which kind of can go either ways, or even there could be liquidity issues in short periods. Over longer periods like 10, 15 years, again these things smoothen out because fund managers are able to kind of rework their portfolios as well. So they are equity funds with high liquidity, so you don't have to worry about those aspects, and they do have high compounding benefit, but you need to remain invested for a much longer period of time because of volatility. In this, you have to be careful to pick well diversified funds with a good long term track record. Now, funds track record should also speak about the fund manager's track record. So keep that in mind and don't just jump into any small and mid cap fund. There are also index funds and ETFs in this category, not as popular because active funds are able to deliver still kind of a premium return over the passive funds. But that is also an option for you in case you do not want to get into the fund manager risk part of it. And flexi cap equity funds are purely diversified funds. Here, the fund manager will decide whether large cap works, whether mid cap works, whether small cap works. And we leave it up to the fund manager's discretion to say which market capitalization may be suitable in which time or which cycle or which year. Again, they have there have been a lot of flexi cap funds around with good track record. So you need to just be sure that you're picking one which has a good long term track record and has a portfolio that is actually optimizing diversification rather than a very constant. They could be concentrated narrow portfolios as well, but the whole point of going with mutual funds is to have optimum diversification. So just be mindful of that. Now, for additional diversification, once you have picked up the experience of being invested in markets and in mutual funds, and you've sort of gone through, a few years and maybe one economic cycle or business cycle, and have seen ups and downs and how these funds work across market cycles, you can start to think about where do I diversify beyond the regular equity funds. And that's where you get international funds, sector funds, and of course, on the fixed income side, the credit risk and corporate bond funds. These are, let me just say it upfront, higher risk. Not for everybody, not for your slow and steady kind of wealth creation. It is meant for people who have better understanding of the markets, more experience in the markets, and are able to absorb this risk not just because they have a better understanding, but because they have an accumulated portfolio which already is sitting on gains thanks to their kind of the earlier investments which they have made in the market. So you have to have that financial cushion already going for you before you get into high risk options, especially things like credit risk funds or sector funds. International funds, some can argue, should be part of your portfolio right from the beginning. Now, you may choose to do that, but they do come with some additional risks that domestic funds don't have. You are exposed to global economics, global politics, global regulatory environment, which is a diversification away from our own market, which is only one particular type of economy, one particular type of political regulatory scenario. However, it can also be a risk because the world is very uncertain right now and we don't know how things can move. So it is good, but can also be a risk. What international funds do is it gives you access to some companies across the globe which are growing at tremendous rates, which obviously you won't have access in India. So that is definitely a plus point. But markets across the globe, capital markets are volatile, and we have to be careful of that. Then, of course, there are currency risks as well involved in it. Some people use international funds to hedge that currency risk because, if they have some expenses coming up in dollars or euros, they can, over the years, not immediately. This also requires you to hold on for a few years before you start seeing the compounding benefit coming up. Be mindful of higher costs because the fund management costs here are higher. Sometimes it's a feeder structure. So you're investing in a fund in India, which is investing in a fund overseas. So there could be more than one layer of cost. So you need to be careful. So you won't be earning the return of the original fund. You will be earning a net return after the costs. So just be a bit more mindful about these things. And again, pick well diversified themes. International funds also have narrow themes like tech or gold mining or energy. If you don't understand those sectors, if you don't have enough knowledge around them, better to stay away and go for the diversified exposures. Sector and thematic funds, same thing, very high risk because sectors can be cyclical in terms of returns. Banking sector does well for a few months, maybe a year or two, and then goes through a slump. Tech sector, FMCG, all of these we've seen that they go through cycles. So your sector fund that you invest in will also go through cycles. And unless you know when to enter and when to exit, you may end up sitting on your sector fund for too long and not making the desired return. Plus, they're very narrow. So, if some regulatory changes come up, if government announces something that impacts the entire sector, or if some developments happen, for example, in the tech sector, we are seeing AI developments happen, which can affect the entire sector, or in pharma sector, healthcare sector, where US regulations impact the entire sector. Then you want to be careful that you don't have too much exposure to one sector because you don't know how that can change the dynamics of that sector itself. So you have to be quite careful about that. So pick funds only if you understand those sectors and themes, not on tips, not because somebody is coming to sell it to you. They are going to be high risk, high return, not your steady compounders in that sense that large cap, mid cap, and flexi cap funds are. Corporate bond and credit risk funds, again, a high risk way to earn premium return. Credit risk portfolios, especially, are ones where you will have bonds which are coming out of, say, a low credit rating, and their credit rating is increasing. So fund managers are taking those calls because that gives a fillip to the price as well. However, the opposite can also happen. We have seen it happen in 2018, where a lot of AAA rated bonds got downgraded in a matter of months to a very low rating, and these funds kind of suffered. So again, these are not meant for the people who are just about beginning. These are meant for people who actually understand bonds, credit rating, how bond prices, interest rates, credit, the grading, everything is linked. So if you understand that, if you have a existing view on it, then you can choose fund managers for this part of it. But otherwise, I think it's better to just stick to what you already know. Okay, now that we've discussed all this, let's talk about within the category of funds, how do you pick funds which you will invest in? Because as we know, there are hundreds of schemes available across categories. In fact, SEBI itself has defined the categories where debt funds, I think, have 16 categories, equity funds have maybe seven or eight, hybrid funds have about seven categories, And there are other categories as well. So how do you choose within large cap equity, within say short term debt, which are the funds that you should be investing in? Of course, one easy way is to get a good advisor who will help you out. But even then, if you want to at least have the awareness of how to filter through, then here are some things that you can look at. It's not an exhaustive list, it's a basic checklist. All right, so common factors are adequate diversification. Do not get into funds which are very concentrated, no matter what asset. You don't want just a few securities determining what your return is, because it kind of negates the purpose of using mutual funds. Also, do not get into very new funds without a track record, without a fund manager track record, and look for schemes where you don't have things like exit loads, at least nothing that is away from what the average fund is offering you. Not too many fund managers have handled the fund. There are many funds available, you have a long list of choices. But if a fund has seen too many hands changing, then obviously every fund manager comes with their own expertise, comes with their own style. So let that settle before you go for it. And not too many similar schemes in the AMC. So the AMC, if it has too many diversified equity funds, which fall somewhat into, say, the flexi cap, then it is difficult to choose which one could be better. Or if they have too many emerging or mid cap kind of funds, which one should I go for? It becomes a bit confusing, right? So try and stick to clear mandates, diversified mandates, and mandates with a track record. In debt funds, you have to be additionally careful about matching the average maturity of the scheme with your goal timeline. As we saw, very short term goals need liquid funds where the average maturities are very low. And as you keep moving up, you can choose funds with slightly higher goal timelines. In debt funds, the idea is capital safety unless you're going for credit risk where you are clearly going for risk. And if capital safety is the idea, pick funds which have AAA rated portfolios, very high credit score, right? So you need funds which are high quality, and you need funds which are matched with your goal in terms of the average maturity. Low expense ratio, because in debt funds, the margin of return is very low. So you don't want expense ratio eating into that. So you want to keep that pretty low. So check that also. And where you want liquid funds, etc., liquid funds may have an exit load for large institutional money, but usually will not have for uh, retail and or individual investors. Maybe a 7 day exit load, which is okay, but not more than that. So you can access your money anytime you need. Short to medium term returns in 2 to 3 year rolling returns should be within the top 25% of the category. So you have many sources to check how returns are doing across peer sets, online sources. You don't need the top performing fund because that will keep changing, but make sure that at least in returns, 2 to 3 year rolling returns are within the top 25% or the top quartile of the peer group. In equity, match the market cap category you want with your long term goal timeline. Again, mid small cap funds are for slightly longer term goals. So don't think that your 5 year goal will be well addressed with a small cap fund. It could be, it may not be, depends on the market environment. Don't take that chance. Fund and asset manager track record, very important. At least 5 to 10 years of managing similar schemes, if not the same scheme. No lock ins unless specifically chosen, which means there are funds like retirement funds and children's gift fund which have specific lock ins. Unless you're going for that kind of fund, just stick to regular open ended funds. Expense ratio should be within the average of the category. You can check all this on publicly available data on Amphi even. And again, check the returns, medium to long term rolling returns, which are 3 to 5 year at least rolling returns, should be in the top quartile. Do not go for the best performing scheme. Very often it may be a narrow mandate like a sector fund. Very often it may be, some kind of new fund. or very often it may just be a fund that's performing well in that one year and not in the previous year. So be very careful about that. Now we come to some questions around mutual fund schemes, which which if answered can help you decide which way to go. So SIP or lump sum, I hear this all the time. SIP or lump sum, and newspapers and media houses talk about it all the time. SIP or lump sum doesn't matter in that sense because you'll be investing in the same fund. SIP is just a facility to invest regularly and to automate your investments. But your money is going into the same portfolio, whether you are making a lump sum or you're making SIPs. Both are good. Lump sum is about investing large amounts in one go. So when you get your bonuses or you get an inheritance and you have some chunky money, you can put it in one fund at one go. SIPs allow you to break up. So as you earn, you can go on investing small regular amounts and you automate it. So once you're done, you don't need to take that action again. Both are available for all kinds of mutual funds, debt and equity. Doesn't mean that in debt you do a lump sum, in equity you do SIP. No, you can do SIP even to create your emergency fund in a liquid fund. So if you want to create an emergency backup financial plan B kind of kitty, you can do that with SIPs in a liquid fund also. Use SIPs to build your short term or your long term investments, and use lump sums as and when they come. If your bonuses and your inheritance is coming in and you already have SIPs running in 2, 3, 4, 5 funds, then you can easily add lump sums to those existing funds itself. So it's not right to compare SIPs or lump sums in terms of returns because there are two different kinds of investments. SIP, you're investing every month, so the return of your first installment will be very different from the return of your last installment. But it choosing it depends on your circumstance. If you're a business owner who gets, whose income is sporadic, you don't know when a lot of money will come, you may end up investing more in lump sum than in SIPs. If you are a regular salaried employee, you may end up investing more through SIPs than in lump sums. So it really depends on how you are receiving your income, whether you choose the SIP or the lump sum mode. For long term wealth creation, however, SIPs build a great habit of investing and saving regularly. With lump sums, sometimes that can't happen. Why is that important? Why is that regular investment so important? Because wealth is created in the long run. And unless you're putting in some money all the time, that wealth creation balloon will not grow as much. This pie chart is just showing you that if you invest 10,000 rupees every month for 40 years, the bulk of your wealth creation happens in the last 5 years. If you see the kind of purple shaded part, it is 44% of the return. It has come in the last 5 years, from year 35 to year 40. And the yellowish part is the 5 years before that has 24%. So bulk of the return has come in the last 10 years. But it's also a very key thing to note that this is 10,000 rupee SIP. So every month for 40 years, 10,000 rupees are getting invested. It's not lump sum. Lump sum will also grow, but lump sum will not grow the kitty which is carrying on compounding. So SIPs actually build the habit of automating and regularly investing, which builds the kitty which is growing bigger. And that is also very important. And it builds the habit of investing and remaining invested, which can help you compound returns for a much longer period of time. Because as we can see, the bulk of the returns come in the end of your investing period, not at the beginning. The first 10 years contribute only 2% to your return if you are doing it through an SIP mode. Okay, active or passive? This is also another question we spoke about a little bit in before. But again, here also you can go for both. Like I said earlier, in large cap equity funds, in the medium to long term, the differential in return between active and passive funds has reduced. And if you see the 5 year, 10-year return, you'll find a lot of passive funds are actually doing better than a lot of active funds. So, because of the nature of the universe of large cap, which I said is pretty narrow, so fund managers also don't have much variety there. The nature of returns is such that they are converging, and passive funds are doing pretty much as good or bad as active funds. So, you can do away with the whole process of choosing fund managers, etc., in large cap funds, and low cost passive funds can also work here. For thematic and style specific funds, active choices are more reasonable because there you are relying on the fund manager's ability to read the theme and to pick the stocks within that theme that makes sense for a portfolio. Again, this is a high risk investment choice to begin with, and then you are adding fund manager risk, so you have to be careful. Factor based passive funds are there which offer variety but are still new and with limited track record. What are factor based passive funds? So they are kind of like thematic funds. Factors are different aspects of equity stock investing. For example, you would have definitely heard of momentum investing or quality investing or value investing. These are all factors, and while it is a passive fund, it means these factors are inbuilt by some kind of quantitative methods, and they're not changed by any fund manager, or they are not, the stocks are not picked according to the fund manager selection but according to these quantitative filters. These are, however, additional factors that you need to analyze and consider whether they fit into your portfolio or not. Sometimes those factors are combined, and there are two factors in one passive fund. So it complicates it a little bit. And these are still new. The track record is not built up. We don't know which kind of factors, which kind of combinations work in which market conditions best. So that data is still evolving. So again, not for beginners, it's for people who understand what it is, or if you want to take a tactical allocation, if you want to take small portion of your portfolio you want to allocate to these kind of funds. Not just costs, but also the basic of active versus passive. The argument is that passive funds are low cost. You can invest in a passive fund for as low as 7 basis points, but active funds can have, up to 200 basis points of expense. So that is a big difference. But you shouldn't always just consider cost. You need to also consider the net returns, whether in the long run, passive funds are really adding to your portfolio or not. And of course, portfolio can have a combination of both. It doesn't have to be either or. As I said, pick passives where the return differential is low, and you can go for active funds in slightly more kind of funds like small cap, where the selection bias does make a difference. Direct or regular. Direct mutual funds are where you are not paying a commission to distributors, and regular mutual funds are where the expense ratio accounts for commissions paid to distributors. Obviously, direct mutual funds are lower in terms of costs, and that means your net return is higher for the same scheme. The same scheme can have both the options of direct, does have rather both the options of direct and regular. Do it yourself investors prefer direct, but you need to understand mutual funds and the risk return dynamics very well, because in different market conditions, which mutual fund works, which doesn't, which mutual funds work for 1 year, 2 year, which work for 8 years, 10 years. If you don't have a sense of that and you're just kind of investing following return, it'll be very difficult for you to hold on to that kind of investment, because when market dynamics change, you may find that the return is no longer in your favor and you may end up selling. It will not help you to avoid those advisor or distributor costs. If you're investing through a mutual fund distributor who helps you choose the scheme, the regular plans will kick in. If you're investing through a SEBI registered investment advisor, you may be paying an advisory fee. Then you can go through direct, because the advisory fee is what you're paying the advisor. In the long run, direct plans will save you money through lower costs if you remain invested. However, the advice of your distributor advisor is also valuable. So it really depends on how much time and expertise you have as an investor. If you don't have much time, but you have some expertise, even then going with an advisor distributor is better, because you don't have the time to see what all new funds are coming in, what is working in what market environment, etc. If you have neither expertise nor time, definitely go with an advisor or a distributor who can help you. Should you go for NFOs, new fund offers? New fund offers are coming up all the time. 12 to 15 were launched in July. If you see what is, in the draft proposals in the SEBI website, you'll find many more are there coming up in the next few months. Remember, NFOs are new, they do not come with a track record, and that's their biggest kind of drawback. You don't know whether the fund is going to do well or not. Plus, there are already so many schemes available to invest in the current mutual fund basket, and schemes with very good track record. So, unless the kind of strategy is really differentiated, if it's another flexi cap fund that is being launched or another mid cap fund that is being launched, you really have to have very good reason not to pick an existing fund with a good track record and go with an NFO which just doesn't have a track record. Maybe it's the fund manager that you are interested in or something, but it has to be a very, very good reason. I saw what do you say, a draft application for a ETF, which is a bond ETF which invests in GSECs, government securities of 8 years to 12 years maturity. So this is a good differentiator because it's a product which will enable you to invest in a passive form in long-term debt allocation and in very secure government securities. So if you have a long-term debt allocation in your portfolio, that can be addressed through this kind of a passive GSEC fund. No fund manager intervention, but simply allowing you access to GSECs in the 8 to 12 year period, which is highly liquid. If there is space in your portfolio for this kind of differentiated strategies, then definitely you can look at an NFO, but without that, it doesn't work. Also, remember, NFOs are not cheaper just because they're coming at 10 rupees, because your investment is the same. So, if you're investing 50,000 rupees, your investment value is 50,000, whether you pay 10 rupees or you pay 100 rupees. And all mutual funds have the same universe accessible to invest. So their portfolio is going to be created from the same universe where your existing fund is investing. So let's say you buy 50,000 worth of units from a new fund at 10 rupees, you get 5,000 units. From an existing fund which has a NAV of 100 rupees, you'll get 500 units. But if the gain from here, when you have purchased, assuming that it's similar portfolios, not different, so in the same category, same kind of investment style, etc. From here, if the return is 10%, your 50,000 will gain 10% regardless of how many units you have. So you will still make 5,000 rupees. So it really doesn't matter. It's not about how low the price of the NAV is. It is really about what the underlying portfolio is, how the fund manager is managing that underlying portfolio, and what you expect that portfolio to deliver for you. So don't fall for that NFO is cheaper. I regularly see portfolios of people filled with different types of mutual fund schemes, and 2 3 years on they don't know what to do with it because there are two different sector funds, there are some new fund offers. It's because they buy into new funds all the time. It's not required. You can have a portfolio of 4 to 5 different mutual fund schemes, and when incremental money comes in, just top those up rather than getting new funds added which don't add any benefit, which is what this caveat is about, that limit the number of funds you own. Each equity scheme can have 40 plus stocks. Some have 80 to 100 stocks even. Be careful not to over diversify your equity exposure, because if you have 10 schemes which have at least 40 funds, you have 400 different, you have 400 in count. There'll be many overlaps. You're not really benefiting from adding more and more funds. People usually have 15, 20 funds in their portfolio. It is definitely not required. Each debt fund also can have 15 to 20 securities or more. So be careful even on the debt side not to over diversify. Go back to why you were investing, figure out the goals, and assign one or two schemes for each of those goals. You don't really need more than that. If your goal is a 15-year goal or more, you can pick small and mid cap funds. If it's 7 to 8 years away, pick the large cap. If it's 6 months away, pick liquid funds. But just maybe one or two across different AMCs, whichever ones you choose. Reevaluate your scheme choices once a year, or in the event of change in fund manager, or if the asset management company, some kind of merger is happening, etc. And then see if you want to change it. For each new investment or SIP, just consider investing in the existing scheme. You don't have to get a new scheme, whether it's an existing scheme or an NFO. You can just invest in whatever you already have instead of adding something new. So, in summary, I just want to wrap up this now. Write down your reason to invest. That is critical to what kind of schemes you choose. Assign a time horizon. Choice of asset depends on this. Decide the asset class and the subcategory within that, right? Liquid fund, ultra short term, large cap, mid cap, whatever. Narrow down to active or passive, which you want, direct or regular, starting an SIP, how much the SIP should be, or you want to invest in lump sums. Don't overdo the NFOs and be careful not to over diversify into too many schemes. This is a very simple, basic way to begin your mutual fund investing journey where you are not over complicating. And remember this slide, this is the most important slide where remaining invested is important along with regular investments because that is what is going to give you that slow, steady, but sustainable wealth creation. So, this is all I have for you all. Thank you so much. I'm going to stop here. Any questions that can be directed? Uh, I'm just going through the chat. Sahil, if there are any questions you can help me
Yes,
with.
ma'am. Yes, ma'am. There are a few questions in Q&A section. They have asked. There are many questions actually. Ma'am, should I pick up or you gonna pick up the questions?
If something comes to your attention, please um, just pick it up. I can see some questions like where to begin. I think we spoke about that. For beginners, if you want to go for long term wealth creation, large cap equity funds is a good place to start. For your emergency fund, for short term kind of allocation of money, or liquid funds, ultra short term funds, those are a good place to start. um, mm, so that those some of these things I have answered. How do you calculate 10-year return? How can you find rolling returns? So there are a lot of websites, and also the mutual fund websites themselves give you this information on their websites. So you can check that, but there are a lot of third party websites like valueresearch.com or advisorcoach.com which can help you at least see. Even money control has so it can help you see different kinds of returns. Why not multi-cap? Sure, multi-cap is a good way to invest. I find flexi-cap better because that gives the fund manager more leeway in terms of which market capitalization to choose based on the market cycle that we are in. Multi-cap is slightly more rigid than that. And flexi-cap funds have a better longer-term track record, more to, it's more comforting to have a longer-term track record, which is there. There are many categories. Remember, we want to keep it simple. We don't want to add on all categories. So I have picked the categories which work for sure and which have the track record and which don't require you to think very much. Okay, I'm a beginner. Where to invest? I think we've already spoken about that. Multi-asset commodity is not there. Yes, commodity is there. I spoke about gold and silver is there. REITs and InvITs are there. Everything is there in multi-asset. Different multi-assets will have different combinations. So you'll have to go into the scheme information document and see what are the assets each that particular multi-asset scheme is investing in. And again, go through the track record. How has it performed in different market environments? Because it's difficult to kind of choose multi-asset schemes just on the basis of looking at return without knowing where they are investing. Um, okay. Yeah. Which schemes are good for 1 to 3 year short-term income funds? We already spoke about. Is there any penalty deductions by fund house if I miss a few SIPs consecutively or intermittently in any MFs? There's no penalty as such. You can pause your SIPs even, and that pause you can do directly with fund houses, or you can do it from the platform that you're investing in. So that is available. ideally you should not be missing your SIPs, and they are automated. So the penalty will come from your bank if there is no money and the SIP mandate hits your bank account. Okay, what else? In US, passive funds are more popular than active because that market is a lot more efficient and has much better price discovery. So passive funds evolved much before. As we achieve more price efficiency in our Indian markets also, passive funds are gaining ground. Like we saw, large caps, the return differential has reduced with active funds. Eventually it will happen with mid and small caps as well, but that is some time away, and our price discovery mechanism in this market is not very good, because also we don't have too many short sellers in the Indian market. So that there are certain inherent characteristics of the Indian capital market because of which the active fund managers are able to outperform still, whereas in the US, that inefficiency has gone away to quite an extent. What to do in a situation if the returns are flat even after 3 years? So returns cannot be seen in isolation. So maybe I should have said this in the presentation. Returns of mutual fund schemes are always compared to benchmarks, which SEBI has mandated that each mutual fund scheme will have a benchmark. That benchmark is matched to what kind of portfolio the scheme has. Ideally, unless your mutual fund scheme is beating the benchmark, it is not doing well, right? Because your option is that you can invest in a passive fund which is tracking the benchmark. So if your mutual fund scheme is not even beating the basic benchmark, why would you pay a fee to the active fund manager? So that is the bare minimum that a mutual fund scheme has to do. It's performing well if it is beating the benchmark. However, there is also a peer set. So there are many large cap actively managed schemes, there are many mid and small cap actively managed schemes. So in the peer set, as I said, look for the top 25% schemes which are consistently able to deliver on a rolling return basis. Rolling returns is a concept slightly difficult to understand, but basically it measures the return of a scheme on a daily basis. So it's not just what is the 3 year return today, but it's what is the 3 year return today, tomorrow, day before, day after, across a wider range of data. So when you see that kind of return and you see what funds are doing well in their peer set, the assumption is that to be in the top quartile, they're already beating benchmark. If they're not beating benchmark, passive funds will take over anyway. So you have to be mindful of that. Firstly, benchmark should be beaten. Secondly, in the peer set, it should be in the top 25% quartile. Okay, I am not able to see many more tax on. Okay, that's gone. It's better to invest in multi-asset or balanced. Again, depends on your requirements. Multi-asset are slightly new, but they're doing really well. Balanced funds have different, hybrid funds have aggressive or conservative. Depends on which end of the spectrum you are. If you're closer to the 5 year mark in terms of your goal, then multi-asset or an aggressive hybrid can work well. Alpha beta Sharpe ratios are risk measures that measure risk adjusted return of a scheme. It's very technical for me to get into the calculation of it, but what you should know is that they measure the risk per unit of return. And well, Sharpe ratio does that. And higher the Sharpe ratio, the better the risk adjusted return. Alpha is just the excess return, and beta is the risk versus the market. Higher beta doesn't necessarily mean you'll get a higher return. It just means that as compared to the market portfolio or the benchmark, this portfolio, is more volatile. Yeah, SIF is very different from SIP. SIF is a new category in mutual funds, and SEBI has allowed them to invest in long short portfolios, which means that they'll indulge in short selling. Definitely not for retail investors right now, definitely not for beginners, more for investors who have 10 lakh rupees at least surplus kept to invest only in things like SIFs, not in other things even. 10 lakh rupees extra only for SIFs. I'm trying to answer as many as possible. Um, how do aspiring fund managers? You'll have to talk to fund managers for that. I'm not a fund manager. Tax on short term fund when redeeming debt funds, the taxation is very clear. It is as per your income tax slab. Whatever the gains are, you will get as per your income tax slab. In equity, long term is after 1 year of holding, and that's 12.5%. And short term now is, I guess, 20%, which is before 1 year of holding if you sell. Okay, Sahil, are we good?
Yes, ma'am. I think it's time to means.
SIF, sorry, one more thing somebody's asked. Does
Yeah,
SIF
yeah,
require
yeah.
similar strategies or knowledge? Like, no, SIF is a very different product, not for the regular SIP investor. Index fund or ETF? Well, index fund, the basic difference between the two is that ETFs require broking account. Because they are available only in demat form. If you don't have a broking account, then you need to go for index funds, which you can do through a statement of account, which is like a regular investment in a mutual fund. You do not need a demat account. So depending on whether you have a demat account or not, you go for an ETF or an index fund. Also, ETFs don't allow SIPs. Index funds allow SIPs. So if you want to go the SIP route, index funds are better. Oh, there are so many other questions. So maybe we can, I can answer some of these offline as well if you send me a list of questions, because it's impossible to answer so many questions. Somebody asked why not balanced advantage fund, because every balanced advantage fund has a very different mandate, and for investors to understand that themselves from the outside is very difficult. Some follow a different momentum kind of strategy, some will follow a p price to book value strategy. It's very confusing, so I never suggest balanced advantage funds if you are doing it yourself. Better to go with advisors or distributors if you want to do balanced advantage funds. Okay, I think Sahil, anything else we can answer? There are, again, people have cited many different types, categories of funds. I have not, obviously, there are many categories, but what works for you? Long term returns show us that basic categories are good enough. You don't need to get into very narrow investing categories, value, contra, multi cap. Not necessary. You need the simple diversified funds to give you the slow, steady, long term compounding. I hope that helps. And I think maybe we will do follow on sessions to answer some of these detailed questions which are coming in more around equity funds. And maybe, follow on sessions which are there specifically to answer these questions may be more useful. Sahil, maybe if you can pick out some of these questions and see what follow on sessions we can do, that will be, I think that will be useful.
Yes, ma'am. Yes, ma'am. I will let you know if it
Yeah,
is possible to do
yeah,
the
yeah. Sure,
answer.
sure, sure.
Thank you, ma'am. Thank you so
All
much.
right. Thank you so much. Thank you,
Uh,
everybody, for
I
listening.
would like to extend our heartfelt thanks for taking time and speaking at the webinar. Your insight, expertise, and engaging presentation made a lasting impact on our audience. Thank you again, ma'am, for your time and
Thanks a lot.
knowledge. Thank you.